And my name is Tori Barabee, and I am the Director of Marketing and Outreach at Morgan Franklin Fellowship. We are delighted that you have joined us today for a really timely topic on Income Taxes 101, all the things that you need to know as you think about filing your taxes, whether it be for the first time or maybe the second time or maybe the 28th time, things that are different this year in 2021 for your 2020 taxes. It is my great pleasure to introduce a longtime friend of mine, Cary Gladstone with the Granite United Way. Cary and I have worked together for many years, and he is the Senior Director of Asset Building Strategies for the Granite United Way. And he leads a very important program here in New Hampshire called the Volunteer Income Tax Assistance Program. So we hope that everybody will have a moment. Cary, during this presentation, maybe you can give an update on what is VITA and what's happening with that program throughout the state this year as well. Today, he joins us to share best practices on a very timely topic, as we mentioned, filing your income taxes for 2020. He'll share such things as understanding taxes, including some important recent changes to tax law, what documents you'll need to gather before you start to file your taxes, and how and when to file. So, Cary, we are thrilled you're with us. Welcome, and enjoy the next hour or so.
It is early February, and it is the start, almost the start of tax season. So that is something we want to talk about. I'm going to share my screen and talk a little bit about how you can understand taxes and what you'll need to do, as Tori said, to file your taxes, what you'll need to know. And it's more than simply when many people have their taxes done. You hear the language of income, adjusted gross income, deductions, and your eyes may glaze over at those things. And then they'll tell you this is how much of a refund you're getting, and your eyes light back up. Well, we want to look at this as a more empowering kind of an opportunity. We want you to say, you know what, we're going to have a conversation today. You'll be on chat. I'll be chatting back with my mic open. And to help you learn a little bit about understanding your taxes, including, as we said, a number of recent changes to tax law, including some that even go back the year before COVID. Do you remember the year before COVID? We'll talk about what tax documents you may need to think about before filing your taxes, and talk about how and when to file. And I'll add this: for free. There is no reason that most people need to pay anything to file their taxes. About 70% of the population generally has an opportunity to take advantage of free tax services. And the VITA, Volunteer Income Tax Assistance Program, that I run at Granite United Way is one. Our friends at AARP run a wonderful program through that they call Tax Aid. You do not have to be of a certain age to participate, but we'll talk a little bit more about that. But for starters, we want to make sure that you have a basic understanding of certain language that sounds a lot like English, but is really a bit of tax as a second language. So for starters, we want to talk about this thing called filing status. So everyone who files a tax return, let's stop right there and say that when you send in your taxes, you're filling out a form. Generally, it's online and you're submitting electronically, but there is actually a form called the 1040. It is the tax return. It's the document you file with the IRS, and you get a refund back in most cases. Now, when someone says to me, I got a return of $2,000, I understand that they mean they're getting a refund based on the return that they file. But I'm just going to use some of the tax law language so that you'll get a basic understanding as we continue through. And feel free to ask questions in the chat if you have concerns or what do they mean by when they say this. So let's start with the status that you claim when you file that tax return. There are 5, and they sound like marital status, but they're not. It's like that. Remember in math, the equal sign that was wavy? It's sort of like, an equal sign that got lost at sea, and it's, riding the waves. Well, that's what the filing status is like. It sounds like what we now think of as marital status. For example, single, the first one listed. When we think of the marital status of single, we generally mean someone who has never been married, correct? Well, you'll notice there's no filing status called divorced. So the IRS uses the filing status of single to mean a person who is not married, either never married or divorced or widowed, but who has no dependents, nobody who they can claim in a way that affects their filing status. They're basically just filing for themselves. Head of household with capital H's is a legal term that generally means a single parent. I have had taxpayers come to me and say, I am the head of household. Well, sit down, sir. Your wife may have a different view. But a married couple would not file as head of household, even if only one of the spouses is working. As we said, head of household usually is a single parent and can also be claimed by someone who is taking care of, an ailing parent in a nursing home, for example. That could count as well. For most people who are married, the status of married filing jointly is the most appropriate. There is a status called married filing separately, and that's usually for someone who they're in the midst of a divorce, but as of December 31st, they were still legally married, so they can't claim that. Maybe there's some things that are causing the couple to want to separate their finances. But for a married couple that has had certain things come into their situation, happily married couple, well, let's say one of the spouses brings to the marriage back taxes they owed from before, or they had a couple of other court related things such as child support, court ordered child support, or they defaulted on federal student loans. The IRS will come after the taxpayer through their tax refund. Now, with married filing jointly, a couple can add what's called an injured spouse. There are two statuses. Injured spouse can be added to the tax return, the document, to say, here's the spouse who does not have those back debts. So it allows you to separate out the income on one tax return and protects part of the refund. So they'll at least get some money back while some money may be claimed to meet that obligation that the other spouse had. Married filing separately can be used. However, there are certain tax benefits, particularly the earned income credit, for which someone married filing separately is not eligible. So those are a couple of the quirks in the tax code as far as the filing status. And the last filing status is called qualifying widow or widower. Obviously, it's a club that nobody wants to qualify for. It is specific to someone whose spouse died during the year in 2020, let's say. Now, that surviving spouse can actually file as married filing jointly if she, and it's usually the surviving widow, and her spouse filed the year before when both were still with us. They filed jointly. The IRS says, well, that spouse who died during the year also lived during the year. So the surviving spouse can file for the entire year of 2020 as married filing jointly. For the next 2 years, if that spouse has not remarried and has what the IRS calls a qualifying child, there's where the qualifying comes in, then that widow or widower can claim the status of married filing jointly, of qualifying widow for 2 full years following the death of following the year in which the spouse died. Got that? Why is this important? Well, it impacts something called the standard deduction. Everyone who files a tax return is eligible to have a certain amount subtracted from their income before calculating how much tax to pay. And it's what starts to make tax law a little bit complicated. The simplest would be, how much did you make last year? Send us a portion of it. The IRS says, we'll tell you what, will give you a standard amount that you are allowed to subtract from your income and calculate the rest as your taxable income, which is smaller than the full amount, and meaning your tax bill will be smaller. So you can see right up front that the person who is single or married filing separately can file and claim a standard deduction of $12,400. So that amount is separated out from the tax return. We subtract that, and then so someone who might have made $30,000, and let's say that the tax bill is 10%, just for the sake of easily illustrating. 10% of $30,000 will be $3,000. If you subtract $12,000 from the $30,000, it's somewhere less than $18,000. Now, 10% of that would be $1,800. Here's a question. You don't need to put this in the chat box, but would you rather pay $1,800 in taxes or $3,000 in taxes? It's not a trick question. Most people would prefer to pay the lower amount, and the standard deduction is a way of doing that. It's basically saying the first $12,400 for a single person is tax-free. Similarly, with the married filing jointly or qualifying widow or widower status, it's twice that, $24,800. And for the head of household, it's right in the middle. And in order to qualify for head of household, or again, for qualifying widow, for most folks, it's having what the IRS calls a qualifying child. Now, where's this language? Again, we know what a child is. It's, one of those little people running around our house asking for things. Would you buy me a toy? And then they go get older and they ask for more expensive things with a deeper voice. Buy me a car. Well, there's also folks who may have a family member who has a disability that affects whether they can work. They're taking care of that person. So the IRS has this language called qualifying child, which can even include a young adult. So a qualifying child for tax purposes is up to age 19 or 24 if still in school full-time in college, or, and this is very important, any age if permanently and totally disabled. We've had instances where we've been able to work with grandparents raising their grandchildren, or people who have an adult child who is not able to work because they're permanently and totally disabled, and this provides a tax benefit for the taxpayer. And that could even be an adult who's caring for their younger sibling who's an adult who is permanently and totally disabled. So it does not have to be a child, does not have to be your child, but it's helpful to understand how that fits into things that actually do benefit the taxpayer. If there are any questions about that, feel free to light up the chat box. I will tell you that there are additional amounts that can be subtracted from the income or added to the standard deduction for filers who are age 65 or older or who are blind. So once again, you would think standard means one amount. You would think that, but you would be wrong, because the IRS has several standard deduction amounts depending on filing status and age or blindness. Now, there's this thing called itemizing. So if someone has different items that they're allowed to subtract from their income, they would add up those items, which generally include mortgage interest, property taxes, real estate taxes, certain medical expenses, charitable contributions for up until this past year, have only been available to people who are itemizing. So your charitable contribution to Morgan Franklin Fellowship is deductible only if you are itemizing. And if those items add up to more than the standard deduction, you can attach yet another form to the tax return listing all those items and get more of a subtraction, resulting in a smaller tax bill. How are we doing so far? Have your eyes crossed yet? Because we're just getting started. There are these things called tax credits, and that's like getting a gift card to pay your taxes. Most of us have a certain amount withheld from our paycheck if we're working for someone else. We fill out a form and we tell our employer, please take a certain amount out to pay my taxes. It's like paying the taxes in an installment plan over the course of the year. except you're kind of prepaying it. So for any of those stores that do layaway, this is like having the tax store be able to take your pay tax payments on the layaway plan. But tax credits are like getting a gift card for your taxes. So it's as if Tori walked into the tax store and they said, "Oh, Ms. Barabee, you've been a very good customer here at the tax store. You qualify for a tax credit. So we give you this gift card to pay your taxes." Here's a little bit of language you should know about tax credits. They are either refundable or non-refundable. Now, a refundable tax credit means the first part of that card is used to pay your tax bill, calculated by your income minus your standard or itemized deductions, and the amount that's left over is your tax bill, or as your taxable income, and the tax bill is calculated as a percentage of your taxable income. Got that? Well, the gift card says the first portion pays your tax bill, and if it's a refundable credit, anything left on that card gets refunded to the taxpayer. If the credit pays the entire bill, there's no need to have anything withheld. You can make an adjustment through your employer to withholding so that you can have more in your paycheck to keep up with bills during the year, maybe put some money in savings. That ties in with Morgan Franklin Fellowship's year-long effort of building financial literacy and giving you more control over your money. I'm a big fan of that concept. So let's just go through a menu of some of the tax credits, and we'll explain about a few of them in greater detail. The earned income tax credit is one that we want to make sure people know about. It's for workers. You have to be working to claim it, hence earned income, whether for yourself or working for someone else. So it could be a self-employed person who's claiming this credit. And for families, it's worth up to $6,660 for 2020. And that amount is generally adjusted every year. The earning limit is adjusted and the amount of the credit is adjusted upward, generally to keep up with inflation. The child tax credit has been at $2,000 for each of the last several years. It allows anyone with a child age 16 or younger to claim a $2,000 credit toward their taxes for each child. And it goes away when the child turns 17. So that's a little different than what I talked about earlier, claiming a child for either the earned income credit or as a dependent. That can go up to, as we said, 19 or 24 if a full-time student, or any age if permanently and totally disabled. With the child tax credit, it's different. It's up to $2,000 and it's up to age 17. That credit goes away in the year in which the child turns 17. However, there is an additional child tax credit that says while the child tax credit is non-refundable, a portion could be considered refundable with this additional credit that's built in. For those folks who do have a child 17 or older, but who's still a dependent, they can get the credit for other dependents. And that's worth up to $500 toward the tax bill. It's non-refundable. It can also be claimed by someone who is paying the rent for a parent who may live separately, who's having health problems. If the adult child is paying the cost of their parents' living expenses, they can get a $500 credit on their own taxes. Making sense so far? Education, yes.
We do have one question in the chat that I'd like to bring to your attention.
Okay.
How do I find out what the additional amount is if over 65?
It is at the IRS website, irs.gov, and I believe it's $1,300 additional to what the filing status is.
Thank you.
You're welcome. Good question. Education tax credits can be up to $2,500. And for example, the American Opportunity Credit is available for up to 4 years, meaning it can be counted as a total of $10,000 toward higher education expenses. The Retirement Savers Credit. This is one that I want to talk a little bit more about in a future slide because it's one that we see people claim kind of accidentally. You know, when they started at their company, they signed a bunch of papers I signed a 401 something or other. Well, what that means is the company is taking some money out of your paycheck to put into a retirement plan. And if they have certain income guidelines that I'll get to, they get an additional credit for being a retirement saver as an incentive to encourage people to put something aside for retirement. And that can be up to $4,000 as a non-refundable credit for people who are married filing jointly. And ABLE accounts, for those folks who know someone with a disability, this is a tax-advantaged savings program that can allow people to claim their retirement savers credit, put money aside for goals that will not affect what are called the asset limits that someone may suffer from, essentially. If they have too much in savings, they're saving for something else, they can actually lose certain benefits like their housing and other benefits. So we want to make sure people are aware of the ABLE accounts. It's a fairly new thing for people with a disability. It's available in New Hampshire, and I can tell you more about that if folks have a question about it. Finally, the premium tax credit is still available for folks who are going through the marketplace. The Affordable Care Act, yes, Obamacare is still around, and people who are not able to get an offer of health insurance through their employer can go to the marketplace, can sign up for a healthcare plan, and get a subsidy to help pay the premiums. That subsidy actually takes the form of the premium tax credit. So there's a nice menu of a lot of things that are available to folks depending on their circumstances and are something they can claim when they go to the tax store. Let's talk about the earned income tax credit, because it is something that many people need to be aware of. It begins with the first dollar of earned income. So remember when I said there are people who are very low income, the first $12,400 of income from working for a single person is tax-free. Well, they don't have to file a tax return. Similarly, with a married couple with $24,800 of income, they may be patching it together with less than that and are not required to file a tax return. The only way they can claim the earned income credit is by filing a tax return. And as we said, it can be more than $6,000 for a family. And it is fully refundable. We've seen people get, a tax bill of around $1,000. They get a $5,000 earned income credit. The first $1,000 pays the tax bill down to zero, and the rest of it, $4,000, comes back to them as a lump sum. And so I say to folks, if that's your situation and you're having additional money taken out, let's use an example. And this is a real world example I had with a conversation with someone who was having $2,000 withheld from her income and literally was getting a $6,000 tax refund. And $4,000 of that was the earned income credit and the child tax credit. And I said, would you like to have more in your paycheck throughout the year? Well, yes. Okay. Because folks say, oh, I'm worried I'm going to have to pay in. I like getting a big refund. Well, if you can make that adjustment and have the $2,000 in withholding put back into your paycheck, you can do that through your employer, maybe split it off into a savings account so the same amount is going into your checking account every paycheck. Let's say that's weekly. That's an additional $40 a week that can be added to your paycheck to either keep up with bills or go into savings, and you're still getting a $4,000 lump sum tax refund. Best of both worlds. But you need to understand that, and the commercial preparers probably don't want you to understand that because they make their money off of your large tax refund that you really don't understand what are all the parts of that. So that's where the earned income credit comes in. And we've learned from the Internal Revenue Service, the agency of the federal government where you file your tax returns, that many people don't claim it. In fact, 1 in 5 people eligible for the earned income credit do not claim it. In New Hampshire alone, based on data I've seen from the IRS, that means about $30 million is left on the table by some of our most in need neighbors. And it includes people who have a disability. They're able to work, but very skeptical, very cautious about anything that they think might interfere with their disability benefits. We want them to know that the earned income credit will not disrupt their disability benefits. Family members with a disability, I mentioned that as well. An adult child who is permanently and totally disabled, they don't realize, yes, adult children can be claimed for this credit. People who are very low income can also claim the credit. And then there are folks who may understand that there's a huge benefit for people who have a child, 1 or 2 or 3 or more qualifying children. They don't realize that there is an earned income credit that can be claimed with someone who does not have a child to claim. Now, it's not as much, only goes up to about $500. Anyone going to turn down $500? So we want to make sure that you know, and it's for people who are 25 to 65 years old. That's another restriction on the people who do not have a child to claim. They're not necessarily childless workers. It may be a non-custodial parent, but we want to make sure, first of all, that those folks do know about that credit and are claiming it. And we've done some advocacy work with others around the country to try and increase the age range of that to allow the youngest full-time workers, people 65 and over still in the workforce, and to raise the amount of the income limit and the amount of the credit. Any questions about that? I want to ask you, if it were up to me, I'd like to deputize Morgan Franklin Fellowship and say, please help us in closing the EITC gap, the gap between people eligible for the earned income credit and those who are actually claiming it. It's a huge amount of money and can be a game changer for a lot of people. Well, let's talk about some tax law changes that have occurred since COVID started. There was the Families First Act, which includes a new tax credit for people who are self-employed to allow them to claim sick leave or family leave. For the most part, people who are working for themselves are kind of on their own where it comes to their family situation, or if they get sick. This is a new tax credit. I've not yet seen guidance on it from the IRS. It's one of the reasons tax season has not yet begun, but we are looking to see how people who are self-employed can claim that credit if they need to. You may recall that when the CARES Act was first passed back in March, it included a stimulus payment, officially called the Economic Impact Payment by the IRS and nobody else. The rest of it just called it a stimulus payment. Well, that is actually an advance credit, or an advance payment toward a new tax credit called the Recovery Rebate Credit. And that comes into play when there has also been a second round of stimulus payments that came out at the end of the year. We'll talk about that a little bit more. For folks who are not itemizing, they can still be charitable. You may already be charitable, but you don't have to pay the taxes on your charitable giving. It's money that you've already earned, but you can give up to $300 to nonprofit qualifying organizations under Section 501c3 of the tax code, if you've heard that expression, a 501c3 organization. You can make donations of cash or pay by check to those organizations of up to $300 and claim a tax deduction for 2020, even if you are not itemizing, and that has been extended into 2021 as well. There is a higher limit on giving for people who do itemize, and we talked about those other items earlier on. That can also include people who are making donations in kind. They're giving old clothes to Goodwill or other things that they're able to get a statement that says the fair market value of your donation is this. Questions so far? It's coffee and conversation. I'm going to also talk a little bit about retirement plans, which are generally a good thing and that may have had some interruptions because of coronavirus, having a big hit on people in their overall financial situation. Normally, if someone who is younger than 59 and a half takes a withdrawal from a qualified retirement plan, there's a 10% penalty. So let's say someone got behind in their rent or mortgage due to the coronavirus, job loss, that sort of thing, and they took $10,000 out of a retirement plan to get caught up on back rent. Now, under normal circumstances, that $10,000 withdrawal would cost them $11,000 because there would be an additional $1,000, or in that case, a 10% payment, a penalty that is charged against those younger folks because the IRS wants to have an incentive to keep that money in there, or kind of a disincentive for taking the money out. Well, for 2020, that penalty is waived if the withdrawal from the retirement plan up to $100,000 was to meet up with coronavirus-related expenses. And that money that is taken out, even though there's no penalty, that money is taxable, but it can be spread over 3 years to reduce the tax impact of that, and can also be repaid over 1, 2, or 3 years so that it lessens the impact, kind of a payment plan to repay that amount. In addition, people who may have received an emergency financial aid grant connected to a higher education institution do not have to pay taxes on that grant. Before COVID, there were some other tax law changes that went into effect back in 2019 with the Secure Act, the Setting Every Community Up for Retirement Enhancement. I didn't think I'd remember that, but they don't just pass a bill, they've got to come up with a catchy name for it. So what this says is, for folks who are making contributions to an individual retirement arrangement, that's if they don't necessarily have a retirement plan through work, but they set one up privately, they make payments into it, that has a tax benefit for it. And people may say, you know what? People are living longer, people are wanting to work longer. I don't want to make a contribution while I'm still working. I want to wait until I'm a little further up the road. And so that contribution limit, the age limit had been 70 and a half. It's now eliminated, but it's going to take a little while for that to take effect. For folks who are working and have a retirement plan, not drawing on it, it was the case that people would have to take a minimum amount distributed from that retirement plan when they reach the age of 70 and a half. Again, and a half, 59 and a half for a penalty, 70 and a half. I haven't used and a half since I was, I think, 7 and a half, and wanted to sound older, a bigger boy, because I was 7 and a half, right? Well, the IRS has revised that minimum distribution age from 70 and a half to 72. For folks who had a baby during 2020 or adopted a child, if they used a distribution or payment from a retirement plan to pay the expenses of the adoption or birth up to $5,000, there's no penalty if they're younger than 59 and a half. So a $5,000 withdrawal would have cost them $5,500 because of a 10% penalty, or $500. That $500 penalty is waived if it allows people to tap that retirement account for the birth of a baby or an adoption.
Cary,
Yes.
it looks like we've had a couple questions come through, so I just want to bring those to your attention. So we have, what documents are required to show a hardship withdrawal from a retirement plan?
We haven't seen that clearly, but I would think if you can demonstrate what the mortgage or the rent payment is, that you can try to make a case for how that money was used. Certainly, if you've gotten a late payment document from whether it's a landlord or a mortgage holder, that would help as well. Other expenses that might come into play. Unemployment would certainly substantiate a loss of income, and could be used for something like meeting car payments or other large expenses.
Great, thank you. And then if there is a plan to repay over 3 years, how will that be reflected on the tax return? Is there an option to indicate that?
We have not yet seen exactly how that will be done. In some other circumstances, there is a carryover type of provision on a document. So that's one of the pieces that you'll have to look at, maybe have some supporting documentation. What we say at our tax sites is, we're not the IRS. We generally will take you at your word if you're preparing that, but you need to look into having some sort of documentation that you can put together. Keep it in your file folder with your pre-printed tax return, so that if the IRS comes calling with a question, you're able to make the case for why it does conform. I think there's going to be a lot of confusion in this coming year, because these are brand new and we haven't gotten a lot of clarity. This is the first year in which this Secure Act provision waives the penalty. How do you document that the income that you took out or the money you took out of the retirement plan is for adoption or birth expenses? You know, it's maybe just showing saving a bill, whether it's for a bill from the hospital for taking that you know, the birth, or you know, adoption might include some legal fees or other expenses, court costs, and so forth, that can be brought up against that withdrawal from the retirement account.
Cary, to the earlier question about the documentation on a withdrawal from a retirement plan, wouldn't the retirement plan holder be sending some type of notification that there was a withdrawal that you may want to take to your tax preparer as well?
You will have to take that statement of the amount of the withdrawal. Yes, that will show up because that is, again, taxable income. So regardless of whether there's a penalty, they still have to pay tax on the withdrawal. But within the calculation for the tax return, there are certain exemptions that people can currently take prior to this. So if it was for first-time home ownership or paying college expenses, there were certain codes that you could put in on the form where you file that and say that this is documenting that you're exempt from the penalty. This right now would be stated as an other.
Okay,
And
thank you.
you're very welcome.
And Cary, it looks like we have one more question that has come through.
Okay.
If we got stimulus checks, how does that affect filing taxes? And do we need to repay those stimulus checks when filing taxes?
These are not taxable. You do not have to pay that money back. But the good news is you can actually get additional money. So what we're hearing at this point, let's move ahead, in fact, to the next slide, whoops, where we talk about the additional stimulus payments that were part of the late December COVID relief fund. So let's just think back. I didn't put it up on the screen. I'm doing this from memory, that most people got a per person stimulus payment back in the spring of $1,200 a piece, and an additional, was it 600, 500 for a child. There was an additional stimulus that came out in December that was $600 per adult, $600 per child. What we've heard from some people is, for whatever reasons, they didn't get that second stimulus, or that they did not claim the child. Maybe the child wasn't born until late in the year. Now they can get additional stimulus for the child. So there will be a new line item on the tax return for the recovery rebate credit, where you would put down the amount that you did receive, and then a calculation will be made to say, oh, you should have gotten this additional amount. And so that amount should be added to the tax refund. Now, what's happening right now is that the IRS, the Internal Revenue Service, and all of the tax software providers are rewriting the code to build that stimulus payment into the tax return. And that's what's causing a bit of a holdup, where normally tax season would have opened by now. It's usually opening in late January. It's February 12th that the IRS will begin accepting tax returns. So how does the stimulus payment affect your tax return? It's first of all delaying it, but it's something that everyone who is eligible for, pretty much everyone who has a Social Security number should be able to claim it. There was a revision in the second round of stimulus payments that allows a married couple where one of the two does not have a Social Security number. They may have an ITIN. They don't qualify for a Social Security card, but they can get an individual tax identification number. Previously, that disqualified both spouses from getting the stimulus payment. Now it is that both of them can receive it, or at least the one with the Social Security number can receive it, and that's retroactive. So that could be a big chunk of change that people will want to make sure that they have on their tax return so that they can get the full amount of the stimulus payment. It is not taxable, but it is something that is going to be calculated through the tax return. Does that make sense? Okay, I hope that answers the taxpayer or the person's question. If they can still have additional questions for clarification about that, they can write into the chat. I will tell you that there are a couple of other important things that have come up during 2020, the year in which many people were filing unemployment benefits for the first time. People in their working lives may never have gone on unemployment before, but it wasn't just individual businesses that were laying off, it was entire industries. The restaurant industry, for one, where people were on unemployment and may or may not have realized that that payment is taxable. So understand that that money, again, with the December relief, there's additional unemployment supplemental compensation from the federal government in addition to state compensation. It does count as taxable income. It does not count as earned income. So for working people who don't make a lot of money, who have qualified for the earned income credit, this can really throw a monkey wrench into how much of an earned income credit they're getting. So an additional measure that was part of the December COVID relief package allows you to take a look at your 2020 earned income and look back to your 2019 income and use whichever year's income was most advantageous in calculating the earned income credit and the additional child tax credit. That's an additional holdup of being able to file. I will tell you that at the other end of that, when people are looking to get their refund, it may delay until early to mid-March. We haven't heard definitively people getting their full refund, but we want to make sure people know that they can still use whichever year of earned income gives them the most beneficial earned income credit, and to say, sit tight. We don't want you going to those commercial preparers, falling prey to their very exorbitant costs. We want you to get all of your money back, even if it takes a little while longer.
Cary?
Yes.
We just had 2 more questions come in. Can you share any tax benefits that people on a visa, for example, H-1B, can claim that we are not aware of generally?
Not off the top of my head. That's a good question. I can take a look at that. H-1B visa. I'm going to have to get back to you on that one. I don't want to misspeak.
Sure. And another one, what are tax implications for cryptocurrencies trading?
That I don't know. The program that we run at Granite United Way does not allow us to do cryptocurrency trading. So, I can't tell you how to calculate Bitcoin, but I can tell you that I can look that up. Good questions. And
Cary, do you know any resources that we could direct that person to for cryptocurrency and implications on, again, irs.gov?
yes, irs.gov is the most reliable, authoritative source. And you will simply go to their homepage and maybe type cryptocurrency in the search box. It will have probably come up before. There's a publication that you can bring up online as a PDF. It's simply called Publication 17. So if you were to go to irs.gov, on the homepage, you can search publications and instructions, simply type in the number 17 and search for it. That is a very thick book written in tax law language, but there should be a way that you can look that up. So when people say to me, tax law is so complicated, well, life is complicated. Tax law simply reflects that. When did cryptocurrency come on into the marketplace? It's been a few years now, and it's now that the IRS has to come up with some rules about that. Similarly with, people are born, people die, marital status changes. All of those things are reflected in the tax code and a whole lot more. So within our program at Granite United Way, the Volunteer Income Tax Assistance Program, it's generally for those more common, people who are working for someone else. They get one or more W-2 statements. They have some other expenses. We can do folks who are itemizing if they have a mortgage and other expenses. We can do certain other things. For example, people who are self-employed can have a Schedule C for self-employment income attached to their 1040. If they're a single person, or, a one-person business, so to speak, no employees, they may not even consider it a business. They may consider it, just a little something they do on the side, whether it's an Uber thing or some other gig economy type of self-employment, and some discussion within that industry of whether those folks are really employees or not, a separate discussion. But right now, we would see those folks as self-employed, people who provide childcare or do like carpentry, house cleaning, all those kind of things may be something that people do for themselves. And they don't have to go to an expensive preparer to do that, as long as the business that they have, that self-employment income, shows a profit for the year. They can have expenses that they can claim up to $35,000 for our VITA program, and don't have things like inventory or depreciation, things that carry over from one year to the next, because those are more complicated. What I would do for those folks is make a referral to the New Hampshire Society of Certified Public Accountants. They've got at their website, which is NHSCPA, not to be confused with the NHSPCA. Dogs and cats will not do your taxes for you, but certified public accountants will. They'll find a CPA function on their website, or you can call their office, where we wouldn't recommend a particular paid preparer, but this is a nonprofit organization that's devoted to the professional development of their members. So I feel confident referring people to that entity if they do have those more complicated tax questions, if they are trading in cryptocurrency, if they are doing some things that are just beyond the scope of what our program covers.
Cary,
Yes.
we had one more question come through asking, so the extra unemployment they sent is taxable?
That is correct. Yeah, that's the other thing. We want to make folks aware of that. Hopefully they were made aware of that when they started and we're having something withheld throughout the year. If that is continuing into 2021, you might want to look at having money taken out so that a year from now, you don't incur a big tax bill. And we can help with those concerns. I mean, that's one of the most difficult conversations that we have when completing a return. Someone finds out that they do owe money to the IRS. You are not going to jail. You did your tax return in good faith, but there may be some financial penalties involved. And so that's one of the benefits of doing the tax return early. Again, tax season will begin February 12th. And if you find out you have an amount due, go ahead and file the tax return. That payment is not due until April 15th. So you have the opportunity to put some money aside until then. If you can pay it all off by April 15th, you're in the clear. If not, you can go to a payment plan, but it's important that you pay down the amount that you have. Pay as much as you can on April 15th, and interest and penalties will be charged on the amount outstanding as of that date. Let's move on to an opportunity to have a little fun at tax time. I like the idea of using tax time not only as an opportunity to meet your tax obligations, as the IRS refers to it, but that you can split up your refund using this form, 8888, attach it to the tax return, and you can put up to 3 accounts on there. So for folks who generally have direct deposited all of their refund into their checking account, they can consider putting most of it into the checking account, but they can also, if they have a savings account, if they have an IRA, an ABLE account, they can put a portion of it into savings as a way of building financial stability now that can help them throughout the year. We know that people do not have enough in emergency savings. That's been true in several surveys that have come out. We know that people want to have more put aside. People may have heard of the Federal Reserve study. I cannot believe it. I have to believe it's been talked about at Morgan Franklin Fellowship by folks who heard the response to the question, could you withstand a $400 unexpected expense without having to borrow or sell something? And as you may have heard, 4 in 10 people of all income levels across the country said, no, I would have to borrow. I would have to sell something. And so to say, well, gee, if you're getting a substantial refund, if you heard about that $400 survey, are you one of those 4 in 10 who would have a hard time dealing with a $400 expense? We're not talking about a month's rent, let alone the 3 to 6 months that financial planners talk about. We're talking about just enough to meet the emergency needs. That it broke my heart to see people lined up at the start of the pandemic to go to food pantries 1 week in. They missed a maximum of 1 paycheck at that point for lack of having enough in emergency savings to just put food on the table. So to say, all right, let's think about ways that you can reduce the impact of the coronavirus. Wash your hands, wear a mask, and make a savings deposit. Because if you do wind up losing your job or having your hours reduced later on as the pandemic continues, isn't it nice to have that money in the bank? Tax time is a great way to do that. And it can be done by direct deposit. That's the fastest and safest way to put that money in the bank. You can also save for the long term. You can buy a US savings bond with your tax return. On that same form, there's space for you to write down just an amount if you want to buy a savings bond for yourself, one for a beneficiary if you want to. A lot of people loved getting savings bonds as a kid. I know I remember my godmother giving me savings bonds and they matured. Well, that was the one that you buy at half of the face value and it matures. That's a Series EE bond. We're talking about the Series I bond. You buy it at face value. So a $100 bond costs $100 and it pays an interest rate that's above the inflation rate, currently paying 1.68%, and it readjusts every 6 months. So it's something that builds interest for up to 30 years, a really nice benefit for someone who doesn't need that money right away, but they can put some money aside for the college fund, or if they think they're going to buy a house one day, this is a great way to start. If the plans change, you can cash that in and not have any loss. Or you can get a paper check. So there's basically 7 ways of allocating that refund. So it gives you a little more control over how that money is used. And we're also participating in the Save Your Refund promotion, which is now, let's go back a page to Save Your Refund, which is run by AARP Foundation and offers prizes, fabulous cash prizes for people who split off at least $50 into one of several savings vehicles. And you can buy a US savings bond with as little as $50 and get the actual bond, or you can put it into savings or some other vehicle. There are $100 drawings throughout tax season, 10 per week. And then at the end of tax season, there will be grand prizes offered. And the woman in the cap and gown there with her son is a single mom named Cassandra from Laconia. She was working 3 jobs when we met her and going to school. And in 2018, she graduated after having submitted to Save Your Refund what she would do with, at that time, it was 2 prizes of $10,000. Cassandra was one of 2 $10,000 winners that year. So we were excited about, really adding to the fun of a refund, and that this year there are 5 chances to win grand prizes of $5,000 each. So 105 chances to win. That's my little commercial for Save Your Refund. We've had a lot of great success. We've had great success with it. And it all comes back to getting your taxes done. So getting your taxes done for free is something that you can do at a VITA, Volunteer Income Tax Assistance, or tax aid site by going to nhtaxhelp.org. Now, you can fill out a form online, or you can call 211 and they'll help you fill out the form over the phone. It's different than what we've done in the past, where you can go in and have your taxes done, leave about an hour later with a completed return. Due to COVID restrictions, we're not able to do that. If folks say they can scan and send their documents to us electronically, we can work with that. And that's no contact. That's the safest of all. If someone has a computer, has the internet access, and they're fairly proficient on the computer, but they need some help guiding through tax software, we can provide phone assist. And that is also through My Free Taxes. If they do need to meet in person to go over their tax documents, we have a number of drop-off locations that are set up. You can get connected again through NH Tax Help or calling 211. And we would meet not only IRS guidelines, but CDC close contact guidelines, which says if we need to be within 6 feet of each other, so we're not talking too loudly about your finances, everyone's masked, and for no more than 10 minutes, that's acceptable. It means that we'll prepare the return itself remotely, ask you questions, as things come up by phone or video chat. You sign a consent that allows us to hold on to your documents, and then about a week later, the return is completed. So that's a little bit different. A quick look at the tax documents you'll need to pull together, no matter how you're doing your taxes. If you have wages from one or more jobs, you'll need to make sure you've gotten the W-2 statements from every employer. You should have gotten them by now. By law, employers are required to send them out by January 31st. So here, as we sit on February 2nd, if you've not gotten that form, you need to recontact your employer and say, hey, has this gone out? Did I miss it somewhere? Can it be reissued if it was somehow lost? Keep that 2019 return handy for any look back provision that you may want to employ, if that's more helpful for the earned income credit, as we talked about. Some of the other things that may impact getting your taxes done in the most efficient way: you can claim a student loan interest deduction of up to $2,500. Make sure you've gotten that statement. If you're self-employed, there's a new form. The 1099 NEC was issued to self-employed individuals who had more than $600 from one place who contracted with them. So they may want to take a look and see if they've gotten any of those. Bank account information, basically the savings, the account number and the routing number for up to 3 accounts. And then any of those other documents that arrive in the mail with a statement on the envelope, important tax documents enclosed. Keep an eye out for those. Interest and dividends, for example, or a tuition statement for someone who's in school or has an adult child in school. Those are some things to look at. If you're going to a VITA or tax aid site, additionally, we will want to have a look at your government issued photo ID, generally your driver's license, to make sure you are who you are, and social security cards for everyone on the return as a way of preventing or guarding against identity theft. For folks who have had that unfortunate experience, they are able to go to the IRS and file for an individual protection personal identification number, or an IP PIN, that they will need to present to us, or they'll need to put it onto their tax return itself, because someone else using that social security number may be floating around out there. They'll have to get a new IP PIN every year that they file a tax return. Documentation of charitable contributions. We don't necessarily need to see the receipts at our sites. It may be just a printed list, but don't be going off the top of your head. We're not the IRS. If you present us with a list that adds up to $300 or more and you're not itemizing, we'll claim that $300 deduction. But if the IRS questions those deductions, especially if you're itemizing, you will need to produce those receipts. So we want to say, we hope you have them at least at home. The letter that you may get from the organization that says, thank you for your contribution. For IRS purposes, this is the amount of the donation. And that's, in a nutshell, it is a nutshell, Tori, you're nodding in agreement. The questions about how to get your taxes done, how to understand what it is you're filing, and how to get your taxes done for free.
Cary, on behalf of Morgan Franklin Fellowship, thank you very much. This was really informative.
All right. Yes. Thank you so much, Cary. I echo Tori's thanks. And for those who don't know, Morgan Franklin Fellowship really promotes financial independence. And so we have this program called our Standards of Financial Literacy program, which is our signature program. And it supports the concept of personal financial freedom. And it gives participants of all ages the insight to set goals and track net worth and apply acquired knowledge. And so it's online, it's self-paced, and it's ideal for individuals and groups alike. And once you complete this 6-module course, you can become an MFF Fellow, which is the ticket to access all additional MFF courses and opportunities for mentoring, networking, internships, and hands-on projects. And these are opportunities for MFF Fellows to continue their journey to personal financial success. So thank you very much for joining us.